Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend David Quintieri, the author of The Money GPS and also the founder of the Money GPS YouTube channel. Quite impressive YouTube channel out there with 250,000 subscribers. David, thank you so much for joining us today.
Thank you for having me on again. It's a pleasure.
It's great to have you. And there's a lot of things happening in the financial markets and the economy right now. If we could get kind of a big picture view of where the economy is right now. I know we're seeing a top bank CEO, Jamie Dimon of JPMorgan, warning of an economic hurricane. That's what he said. And we're also seeing, negative GDP for last quarter. So, are we heading into a recession? Where are we headed? We're seeing the stock market roll over. Your perspective.
Yeah, so great way to start. You look at what I call him Jamie Dimon, said, as well as the president of Goldman Sachs. His name escapes me at the moment, but the president of Goldman Sachs said basically the same thing. And it's that, the economy is in such a bad place, and not because of one thing. It's not subprime, it's not Bear Stearns, it's not Lehman. It's basically every single thing happening all at the same time. So we see all of these activities, and what's the solution? Oh, print more money. But guess what? 2 years ago, they printed more money than ever before. Everybody knows that now. The government did the stimulus like they've never done before. That was 2 years ago. Okay. So the solution has already been provided. They've already, I always like to use the analogy of, the tired person chucking back an espresso. Well, how many espressos can you have? It ultimately doesn't have the same stimulative effect anymore. And that's the kind of world we are in right now. The economy, it's like you have to go to sleep sometimes. That's a healthy part of the whole process. You can't stay awake 24 hours all the time. But that's what especially those who are over leveraged, they want this to perpetually continue, but that's senseless. It doesn't work like that.
No, when it comes to what we're seeing the Fed doing, we have seen for, a decade now, easy money policy, really since the 2008 crisis, the Fed increasing their balance sheet. Now we're seeing tightening. And for many years, people have been saying, well, the Fed is trapped because we're going to get to a situation where, there's inflation, but then the stock market is crashing. And that's what we're seeing right now, possibly, is how can they raise interest rates anymore without completely collapsing the economy? And if they don't raise interest rates, then we see inflation just will continue to run hot. So your perspective, where we are right now, are we coming really to a turning point, or is it really coming to reality that the Fed really is trapped now?
Yeah, so there's an obvious fact. When you print money, you create inflation somewhere, okay? And we're talking about price inflation, of course, because the expansion of the money supply and so on. That is already baked in. You can't turn that around, okay? So what they do is they increase rates. But imagine we printed during the financial crisis, especially the Federal Reserve, but all central banks had done this, where we just printed the maximum amount of cash possible. And it takes a long time for that stuff to move around within the system, because you go from one bubble to the next bubble to the next bubble. You just keep on doing this. And here we are today, 2020, there was this small drop in the markets. If you looked at it, okay, it was quick, but the markets fell 20, 30%. And what did they do? They ran out with this ridiculous stimulus, and it pumped everything up, keeping it alive for a little bit longer. But you cannot continue this. This is ridiculous. So anyway, I'm not sure exactly what their intentions are really, but this is at least, what I'll tell you is at least what we can anticipate for this time. And that is, we will see 50 basis points in June. We might see 50 basis points in July. September is the only questionable one. So we know that the interest rates are going to be approximately 1% higher than where they are today by the time we get to July. So the July meeting, we're going to see interest rates at 1% higher. So imagine what mortgage rates are. And what is the impact of that on the housing market? over leveraged people, all the businesses that have been borrowing for super cheap money, obviously it's going to have an impact. We know that. And the point here is that this is in a world in which we're addicted to cheap money, this is going to be a problem. It is. And they know that. The Federal Reserve knows that. But many would say, no. You see, because the Federal Reserve is friends with all of their friends that are rich and own a lot of stocks and real estate. So they won't do that. But if you look historically, this has always been the case. They take the punch bowl away, assets fall considerably, then their friends come in and buy everything up for pennies on the dollar. Oh, and then everything can go up. Nobody wanted to own real estate after the housing crisis. Nobody wanted to touch the stuff. It wasn't everybody was saying, oh, now is the time to buy. So few people were saying that. But those who did obviously benefited considerably. But remember, it didn't happen right away. It wasn't, oh, here's QE, and now suddenly everybody rushes out to buy real estate. There was still pandemonium inside the markets and the financial markets, and getting access to credit was difficult. So I don't think people understand how this all works, because all they saw, many only saw the crash of 2020. That was a dip. That was the only real dip since 2009. So beware.
Now, when it comes to what we're seeing in the markets today, we continue to see the stock market. I mean, we see a turnaround in the stock market, it seems like, in the last week or so, and precious metals seem to have hit a bottom. We're seeing good strength in both gold and silver. Gold is rushing back towards that $1,900 level. As we speak, it's around 1875, and silver is above 22 again, around 2240. So your perspective on where the markets stand right now, and as we look at the precious metals, do you think we've hit a bottom?
It's difficult to do any price predictions, but ultimately, the more turmoil there is, you see the benefit initially in gold, and then I believe silver follows behind and exaggerates whatever gold does. That's usually the case. There was talk about, Bitcoin is the new gold, Bitcoin is the new inflation hedge, and so on. I had always said, I don't think so, but anything is possible. However, we just don't have the history behind that, so nobody should be suggesting that. And the price came down quite a bit. I mean, gold has held quite strong at this level, hasn't necessarily appreciated like some of these meme stocks or something, but it's held on quite well when you look at other assets. In terms of, where it is in the cycle, there's always going to be, this is what I will say about gold. When you look at people's ownership of gold, number one, it's something that we should never be watching the price on. That's just the way I look at it. Why? Because the price of gold is always going to be fluctuating because we're looking at the paper price. But real physical metals are always in high demand, always. There's so many, you always hear the stories. This mint, this dealer, they're out of stock. They're out of stock on this, on that. Why? Because they're buying it. People know the true value of this stuff, and they're buying it up, physical stuff. Robert Kiyosaki's latest book called Fake, he talks about saving God's money. And he's saying specifically, this is about gold and silver, saving it. But you would never sell what you save. That wouldn't make sense. So you're saving it indefinitely. So that's what I really like about that. And it's simply just accumulating, keeping it forever. That's it. So the price, really, it's inconsistent with the way I look at it. I just always see it as having value. Now, maybe something appreciates more than gold. That's certainly possible. But if people would look at it as a percentage of their total portfolio, whatever that percentage is to you, then I think they would just be better off.
Now, we have a viewer's question here, and just a reminder for our viewers, we have David Quintieri here from the Money GPS. Those who are just joining us right now, we are live here. And the question we have from Thomas is, how much further do you think the stock market is going to crash on a percentage basis? And also, we had another question earlier on a viewer wanting to know your perspective on these calls for a melt up in the stock market. I know David Hunter has called for a melt up before a major crash occurs. So your perspective on all of that.
Yeah, maybe I can put it into one. So in terms of the melt up, in order to have a melt up, we need to have central bank infusions. It doesn't necessarily have to all come from the Fed, but it seems like on a global scale, we are entering a tightening conditions globally. The only central bank which is promising to go in the other direction is China. At least, even with the ECB and the Bank of Japan, they are saying we want to be tighter, whether that happens or not. Anyway, so in order to melt up, it's very difficult without quantitative easing. That's the kind of world we live in today. In terms of how far the markets can fall down, I would look at, this is a very simple way to do this. Number one, 200-day moving average. Paul Tudor Jones, one of the most successful investors of all time, loves the 200-day moving average for a reason. Okay, look at the S&P 500 and look at different indicators, like a stochastic indicator, like an RSI indicator, MACD indicator on a monthly chart. When you see these things all adding up, you pull that back, way back, years and years and years and years, and watch what happens. It's very predictable. Okay, you can never pinpoint exactly, but you can kind of feel it out. So if you do those things, you do your own research, you're going to be able to see for yourself. There's always this letting off of steam that happens in the markets. That's all we've had so far. There has been no crash so far. I'll tell you when you'll see the bottom. It's when meme stocks and NFTs that are, of 7 pixels on the screen, when people start to say, I thought that was good, but actually it's garbage, and then nobody wants to buy it or hold it anymore, that's when it's the bottom. But right now, you see it's still going on today. Still, people are still loving that stuff. And there's nothing, I don't have anything against any NFTs or memes or whatever. I'm just saying that when we start to turn our heads away from that which is actually valuable to things that are more of an idea, we start to have these reverberations from 2000 into the present, and that's the problem. And then the truth is, nobody ever sees it while it's happening. It's only when it's written in a book and somebody says, oh, wasn't that so obvious? Like during the housing crisis, everybody talks like they're so smart today. But did anybody see the housing crisis? Maybe a handful of people, maybe. Why? Because it's all swept under the rug. The media, CNBC and Bloomberg, there is no question that they will never give you a heads up on anything important. So you're not going to get it. So that's just the way it is. So that's it.
No, I think you make a good point that a lot of these meme stocks, they're more of an idea right now. And we need to realize that there's so much in the market that is fake and just kind of an imagination. And one way to really step out of this imagination is to hold real assets, gold and silver. Take control of your finances and become your own central bank. As Gregory Mannarino often says, is really hold your wealth in your own possession. Your perspective on that, other ways that people can really get out of this imaginary financial system, if you want to put it that way.
You have to understand the way that the cycles work. Okay. So, the typical influencer on YouTube will tell you, if you buy into the stock market, if you buy this particular stock and it crashes down, great opportunity to buy more. But this is truly an ignorant thing and a disservice to the community. But people have been, number one, influenced by the influencers, obviously, but they just haven't spent the time to look back. Look, if I buy Netflix, okay, I don't even know what Netflix is at or was at previously, but the price dropped 75% or more. And let's just make up a number. Let's say it dropped from 100 and it dropped down to 25. Here we go. Now it's $25. All right, now's the time to buy in, because now it's going to go back to 100 and potentially even more. But how long does it take to get back to 100? Is it 5 years? Is it 10 years? In 5 or 10 years, or whatever that number is, does Netflix now have more competitors? Does Netflix now have the same amount of subscribers? Does Netflix even exist? Was it bought by another company? What happened to it? Well, there's no way to tell. And so we don't know what the price will be into the future. And so that's why it's important not to, number one, overextend ourselves. Number two, to diversify, and to simply be smart, to be prudent about where we are putting our money. Just because it hit a price in the past doesn't mean it's going to be there in the future. So that's why a lot of people, I give credit to a lot of people that simply buy ETFs of the market in general, because they don't know. They don't know what will happen. And of course, that's the truth. You don't know what's going to happen to the stock market. It's impossible to know. But we know that, with the individual stocks, we never know. Amazon, take perfect example. Amazon, everybody was doing their shopping on Amazon in 2020. You wanted that toilet paper, you couldn't go to the store to get that toilet paper, they were sold out. So you went to Amazon and you paid $100 a roll to get that. And that's just the way it was. But the stock stopped going up in like June or July or whatever it was of 2020. And it just chopped. And it's, we are now at one point, we were back down to the levels of like 2019 or 2018. It was so extreme to what we have seen. So you cannot anticipate future price movements in that way. But we can diversify broadly, and that's important. Ultimately, what I'm trying to tell you after all that ranting is you want to diversify, you want to hold real assets, because we want something that has tangibility, that has a history.
Now, you recently made a video a couple months ago, actually, about diversification in your really location that you're going to be living, and to have multiple plans, because what could happen is we see this market crash and the economic downturn, and things maintain the system maintains intact, but a lot of people are looking at what is happening right now, and we're seeing possible food shortages coming soon, a lot of things that could just completely crash the whole system. So your perspective on ways that we can prepare for the future, and how does really our living situation play into that?
Okay, so it really all depends on your current circumstances. What is your job situation, your income, your current assets? Like every individual, they're going to have their own situation. Okay. But what I would say is, optimally, what we want is to have at least some control over our food. And that's something as simple as having a backyard garden, having storable food, cans of food, pasta, any sort of dried food, beans, so that if the food supply goes down, as we see it has a lot of problems, that we have some level of preparation. Geographically, we would also want to diversify too. You see, if people have turmoil where they live in the big city, and why do they live in the big city? Maybe because their job is within half an hour or an hour drive, but maybe it's a metropolis of 5 million people. Well, those are generally unsafe areas to live in a crisis. So maybe they have a cottage. Maybe that cottage is 3 hours away. It's in a low population density area, and maybe there's farms around, and there's just generally less population, and so on. Now they have a place to live in as their normal home. They've got a cottage to go up on the weekends. It's just them enjoying themselves. But it has the advantage of, if the stuff hits the fan, they can go for a drive and they're up there and they're much more safe. You see, and people don't think of it like that, but that's an asset. That's an investment in a sense, because it's insurance. It's very important. That's just the way I look at it. And I try to be very practical about it. Some people will say, well, one thing or another, but, everyone has their own opinion. I just think that we have to be very practical about the situation. Somebody will just say, yeah, move out into the woods. Well, that's not going to work for everybody, right? It's just not going to happen. So can we have a plan B? That would be fantastic. If everybody had a plan B, we'd be much better off, I think.
I think that's so key is that everyone's situation is different, and having that plan B is better than nothing. And if you do live in the city, having somewhere more remote, or maybe having family that's more remote and talking to them. I think another key thing is building community as well. So you have other people to lean on, and they can lean on you if this all comes down.
100%. Yeah, get your plans in order before. I mean, you can't expect that, if stuff gets really bad, then I'm going to get serious. It's already too late.
Now we have a couple more viewers' questions here. And again, for our viewers just joining us here, this is David Quintieri from the Money GPS, and it's great to have you on, David. One viewer is wanting to know, this is from Love Button, and they're wanting to know, is Dave bullish on commodities and specifically oil and gas?
Right now at this time. So I've been talking about commodities like very seriously since 2020. I've been really, really talking about that. Now, if you look at oil and gas, there's two factors here. There's supply and demand, normal supply and demand fundamentals, okay? We are also seeing what's happening geopolitically with Russia, Ukraine. So that's another issue. So where is the real price of oil right now? Well, it depends. Like OPEC just said, we're going to pump 50% more oil. That has an impact on how much oil comes onto the market and affects the price directly. But in general, if you compare the makeup of the stock market, compare it to how much is made up of commodities, how much is made up of tech stocks or whatever, the ratio in between these things, commodities went non-existent for so many years. After the 2008, they just fell down through the floor in general, were so cheap, whether it was natural gas or whatever. And now I think it was Goldman Sachs who said, this is the commodities super cycle. According to them, it's bottomed out. Now, the only thing that turns around the price of commodities, other than, for instance, OPEC pumping out 50% more, is demand destruction. And what does that mean? That means recession. So if suddenly people aren't traveling in airplanes, if people aren't, going to the supermarkets to get, or I shouldn't say the restaurants, the movies and the shopping malls and all this stuff, and they're not spending, well, then less is needed. Less housing is needed. Okay, no longer lumber, no longer copper, no longer all these different commodities. So, I'm bullish to the point in which we are still seeing the demand. But what's happening with interest rates is that they're rising. And so that will have an impact, not overnight. But I'd rather own commodities than, meme stocks and that sort of thing. So if I was going to buy into a portfolio of paper assets, I would want to have sort of a broad market, but I would also definitely want to have separately commodities. If you're going to go ETFs, then those ETFs, you definitely want exposure to commodities. There's no doubt about it. But you could break it down into energy or metals, for instance. And so those are broken down. There's a big discussion with that, but I think commodities, is a big term. And I don't, by the way, I should say, and I don't consider gold and silver to be commodity. When I talk about commodities, I'm talking about everything else, essentially.
Right. And I know that you were mentioning earlier in the interview the importance to realize that there's a difference between the paper markets and the physical markets. So when it comes, and that's in the case of commodities as well, because I know we saw, a few months back in the nickel market, quite big distortions happening in the
Oh
paper
yeah.
market there, where they had to shut down the exchange and everything. We have a viewer's question about this. They say if a major crash occurs, and I believe they're talking about in certain commodity markets, I expect to see a force majeure on a lot of contracts. What contracts do you think are most likely to be rewritten or renegotiated?
I'm not one to speculate too much on that, but there's always been this talk about, the true price of gold because of all the suppression, the true price of silver because of the suppression. And you know what? I don't know. I really don't know. Is it being suppressed? 100%. Absolutely. There is no question. We know that. And why? It's because it's really easy to do. Every time they get caught, basically rigging the price, every time the quotes are the same. Well, everybody was doing it. Everybody was doing it. And I thought it was just okay. I thought it was just kind of a thing. They always say the exact same thing. So nobody's watching over these markets. And we know it's probably not just gold and silver. It's probably just the one that it's kind of easy to pick on. But I just personally, I just don't look at, gold and silver like that at all. I just don't. The price that you see is a fraud. And maybe one day we're going to see the price that they show us on the spot price to be real. I don't know. I don't even factor it in. I just look at gold and silver as something you want to hold on to and pass it down. That's it. That's just the way I look at it.
Now, do you see the price rigging in the precious metal markets more as just merely rigging the prices to make a quick profit, or do you see that actual suppression is going on?
Well, and you know this, but according to GATA, I mean, they have documented this fully and extensively. That, I mean, this is speculation, but that there is an ulterior motive to do so. Because if gold is strong, you got to understand, like all these guys in the financial industry, they hate gold and silver, physical metals. And why is that? Because you owning a lump of metal and putting it in a safe deposit box or putting it under your mattress is not going to do them any good. In fact, it's a disservice, because you're going to pull cash out of either the bank or you're going to pull it out of one of their products, and they can't make those commissions. These are companies that exist because of fees and commissions, and you're going to take that out to put it into a lump of metal. They won't even look at you. So obviously they have a reason, and I get it. It's a business, right? If everybody owned precious metals, it would hurt them. It would hurt them. And that's their bottom line. That's what keeps them employed and so on. They have to feed their families. I understand. But if you're here for the truth, well, then that's a whole different story. So that's just the way I look at it. I mean, you take what you want from that, but I think it's pretty obvious.
And if our viewers are here for the truth, they can always check you out on the moneygps.com
Yes,
and the Money GPS YouTube channel. Are there any last thoughts you'd like to leave with our viewers? And could you remind them where they can find you?
for sure. Yeah. So what I would say is, whoever it is that you're listening to, make sure that they understand history. Okay. Make sure they go way back, and don't ever let anybody tell you that this time is different, because sure, there are always differences. Every single cycle is different, but there's so many pieces of that puzzle which are going to be seen over and over again. And what are those things? There's a level of excess, and then the party's over. This is something that happens every single time, and we are witnessing part of that today. The only potential savior right now is a rather let's say weak recession, because that just kind of slows things down. We let the steam blow off, and then they could start again and grow. But you can't grow in a situation in which we haven't reached actual fair valuations in the markets. In the economy is just bleeding out. You shipped all the jobs overseas. Anytime somebody wants to make money, you tax them higher and higher levels. You're reducing incentive. Right now, they're in the process. I think the process is happening of canceling student debt. So they're going to cancel a portion of student debt. Can you tell me, do you think students are now ever going to pay that student debt? They're just going to say, hey, if I hold off, they're going to pay it for me. So I'm not going to pay it off. What happens? Well, the debt multiplies and gets more and more of a burden. And the same thing. Well, hey, you paid some student debt. Why not pay my credit card debt? And so they're not going to pay their credit card debt. And this only gets worse, and it only compounds. And the problems get worse and worse. And the only solution at the end of all of this, I believe, this is my belief and what I've studied, is that eventually we go towards a universal basic income. And that, imagine, comes directly from the Fed in the form of a central bank digital currency. They have everything under their control. They will pose as a savior. They can give the universal basic income. Hey, everybody, you want free money? $500 a month, $1,000 a month, whatever it is. No worries. Right on your phone, you'll have that. You can scan it any store. There's your free money. They give people a way to put millions and millions of people onto their system in which they have full and total control. And they only need one crisis to do it. So that's my thoughts on that. I think it's inevitable, whether it's during this crisis or the next or what have you. But it seems very clear to me that that's the direction we're headed. So that's that. If you want to find me on every media platform you can think of, at The Money GPS.
And I think it's so important that people share this video and hear what you just said about what could be happening in the future of what the Federal Reserve might do with the digital dollar and universal basic income and everything like that. Because whenever we see a crisis, and it seems like we're heading into one, the government always steps in to try to save everyone, and it ends up reducing people's liberty. And that's really the point behind this channel, Liberty and Finance, is to help people get prepared so that when the government tries to step in, we don't need the government to save us this time. So definitely share this with everyone that you know to get people aware and prepared. And David, once again, thank you so much for your time, and God bless.
Thank you.